Theresa May's Brexit deal proposition was defeated for the second time on the 12th of March, just 17 days before the Brexit deadline, the day after the UK Parliament voted against leaving the European Union without a deal. And the day after that, they voted to extend the March 29th Brexit deadline. What does this mean for Brexit? And what should Canadian investors look for? Asset Allocation Director at WisdomTree, Jeff Weniger, is here to share his perspectives. Jeff, thank you so much for being here today.
Absolutely.
First up, what do you think is going to happen?
Yeah, I know it's a Brexit discussion. It's fascinating, Ruth. I think that the key to understanding and getting your mind around the interrelationship between Britain and continental Europe is to really look at the history of Europe and the European project, the European question, various referendums in the last generation. Essentially what will happen is the Brits will be treated much as the Dutch and the French and the Irish were in various European questions through the years. So back in 2005, the Dutch and the French were asked to essentially ratify the Lisbon Treaty for an EU constitution. They voted no, and so they got ignored. It's essentially the way it went. Then in 2008, the Irish were asked to ratify Lisbon. They voted no, and they said, no, revote. So they did a public relations program, and they revoted, and whoop, voila, they voted yes. And so this is where this is going, I think, is this series of extensions. Maybe you extend once, maybe you extend 5 times until you end up getting the initiative, which is the end game here, which is to get them to vote a second time and then vote, okay, we're sorry, we made a big mistake, we're going to stay. This has been the European game plan for a generation. I don't see any reason why the 4th country to do this would be any different than the prior 3.
Do you think UK equities are attractive right now?
Yeah, absolutely. I would say UK and European equities, so long as you're hedging back to CAD as your default. We don't see any reason necessarily to be bearing undue pound or euro risk, because the Brits have their own situation, as we've discussed, but the Europeans have parliamentary elections coming up in May. There's big questions as to will the protest parties end up rising there, and what good is it losing a nickel or a dime on your exchange rate when you could just own the equities and hedge back to CAD? So that's something that's a key consideration there. But British equities have a 5% dividend yield. Continental European, Eurozone equities, 3.5%. It's considerably higher than what you can get in the low 3s on something like the TSX comp. So there's a value trade there for those that are willing to bear that incremental risk, the political risk.
From an investor standpoint, you recently analyzed companies that had their revenues both in the UK and in the Eurozone. What were some of your key findings?
Yeah, absolutely. And you saw this everywhere in 2018. What we do a lot at WisdomTree is screening out companies based on whether or not they have big export businesses, because a lot of the currency hedging concepts that we do at the firm have to do with exporters are more susceptible to the vagaries of their home domestic currency, particularly relative to USD, but generally against all pairs. And what we found was, whether it was in Europe or in Japan or even in China, you've seen it within the state-owned enterprises and the non-state-owned enterprises in China, was that there was a key, a critical directional gap performance-wise in 2018 because of trade wars. So if it's going to be the other side of the trade in 19, if trade wars, going to wash your hands of it, Trump ends up making nice with Xi Jinping, everything kind of becomes the opposite of the 2018 trade, then it would be the exporters that would end up theoretically regaining market leadership because they woefully underperformed last year.
Thank you so much for joining us with your perspective, Jeff.
Sure, Ruth, absolutely.
For Morningstar, I'm Ruth Saldana.